So positive just in that final moment of trading. Everything else closed down. Welcome back to Closing Bell. I'm Sarah Eisen, along with Wilfred Frost and Mike Santoli, CNBC senior markets commentator. Take a look at how we finished up the day on Wall Street. Dow closed up. As you can see, it was red all day long. We got as low as almost 350 down, and we finished higher 22 points. Thank you, United Healthcare, Caterpillar, Johnson & Johnson, Home Depot. Those were some of the winners. No thanks to Salesforce, took 42 points off the Dow. Apple, Microsoft, all bringing up the rear. There's the S&P 500 down a little more than 0.6 up 1%. It was a tale of value versus growth, really. Materials, financials, and energy all closed higher. So did industrials and healthcare. Technology at the bottom of the pack. The ARK Innovation ETF, which a lot of people watch as a tech and momentum proxy, down 3.7% today, closing below its 200-day moving average. There's the NASDAQ down 1.9% on the day. By far the biggest loser, though. It was looking worse at some parts of the day, but has pretty much been lower all day long. Focused on higher yields, higher interest rate comments from Treasury Secretary Janet Yellen. And also just continuing the correction. The Russell 2000 index of small caps down 1.3%. Coming up on this hour, we've got much more on today's wild action and whether falling tech stocks are starting to look attractive when we are joined by Fairlead's Katie Stockton and her charts. Plus, investors are now awaiting quarterly results from Lyft, Activision Blizzard, T-Mobile, Match, Zillow. We'll break down all those results as soon as they are out. First up, let's talk about this market. Paul Hickey from Bespoke Investment Group is still with us. Greg Branch, managing partner at Veritas Financial Group, joins the conversation. Welcome, Greg. Though first, I'll send it to you, Mike, on what triggered the selling in tech and where it fits into the bigger picture.
I don't know that we have a good answer of specifically what triggered the selling, except for the idea that very conspicuously the stocks couldn't do a lot with great earnings, and then we're out of things to look forward to specifically in tech right now. Also, the general sentiment of this economy is in a brisk expansion right now. We can play it in various ways, even if we're off the peak growth rates. It seems like if you had an interest in putting any fresh money in this market or just finding a new place for it, it's going to be in areas that are exposed to those trends. And I don't know that I want to, try to draw a story beyond that. Even with Yellen's comments, it seems to me that happened at, 11 a.m. NASDAQ was already down solidly before that. So I do think it's much more a matter of a messy phase in the ongoing rotation we've seen. But also the overall market has kind of stalled out or broken stride a little bit. And we're in this period of just chop in the last couple of weeks.
Greg, do you think that these little pullbacks will be just that, just little, given that all of the data and the earnings has been so positive?
Look, I disagree with Mike a little bit. This is something that we've been waiting for and watching for the Fed to change its posture. It warned us that it would signal that, and I think today constitutes that. I think Treasury Secretary Yellen was very intentional in what she said. And I think the market did exactly what we would expect it to do when inflation worries come to the fore. We saw sectors that benefit from rising yields, such as the financials and an improved net interest margin environment. We saw commodities and things like that benefit, that can pass on the pricing. And we saw tech suffer. And in increasing interest rates, are more deleterious for growth and tech. As we look out to the earnings streams that we're valuing, those earnings streams have a lower ceiling as the money that is used to fuel that growth becomes more expensive. And so I don't know if this is temporary, if this is going to be something that is going to persist. Once we figure out if the inflation is going to be more acute than the original 2.2% or so that the Fed said that they were comfortable with, or if it's going to be more persistent than the couple of months that they said they were comfortable with. Either way, if they are changing their posture, I expect that to weigh on the results over the next few months.
Oh, so much there that we could chew on. But we've got to get to some earnings first. T-Mobile just out. Let's get to Julia Borston. Julia.
T-Mobile beating across the board, reporting better than expected results in the top and bottom line. Earnings of 74 cents per share, beating estimates of 57 cents per share. Revenues of $19.8 billion, beating estimates of $18.9 billion. The company reporting net additions of 1.4 million new subscribers. The estimates had been for about 1.2 million. The company also raising its guidance for 2021 net additions to between 4.4 and 4.9 million, up from the prior guidance of between 4 and 4.7 million. Also increasing guidance on merger synergies, saying merger synergies with Sprint will now be between 2.8 and 3.1 billion. So overall, rosy guidance for 2021. That stock now up over 3%. Back over to you,
Julia. Thank you, Mike. Julia mentioned up 3%. Market's also going to like that added synergy cost savings as a result of the merger, which they've been focused on.
Well, they've been kind of thriving on that for a while. The market has loved the merger, as I think everyone anticipated if it got approval to kind of create this, kind of trilogopoly or whatever you want to call it in the space. Now, the stock has sort of sagged a little bit recently. It has been kind of hovering below its highs. So now we have a little bit of a perking up back toward those highs. So this isn't new ground, but definitely a net positive reaction.
Let's get Lyft's numbers now, which are just crossing. Deirdre Bosa has them for us.
Hey, Will, Lyft shares are popping in the after hours after the company beat on both the top and bottom lines. Revenue coming in at $609 million versus $559 million expected. That is a decline of 36% year over year. Ride sharing continues to improve, so it is a recovery from Q4, up 7% from the previous quarter. Loss is much better than expected. Loss per share of 35 cents versus 53 cents expected. A net loss of just under 400 million. Adjusted EBITDA, this is the number I told you guys to watch. That continues to improve quarter over quarter and year over year, better than the company had expected at $73 million. So getting closer to that adjusted EBITDA profitability the company says it will reach in the third quarter. I did catch up with president and co-founder John Zimmer not long ago on driver supply. He said that heightened demand is a good problem, and they are starting to see supply improve, a trend that he expects to continue. He also said that they're not out of the COVID wins just yet, but they are feeling the tailwinds, and they are emerging from the pandemic leaner and more efficient. Guys, we will get guidance on the call, so we'll be listening and can bring you that when we get it. That kicks off in about 20 minutes.
Dee, thanks so much for that guidance on the call, but also don't miss tomorrow. First on CNBC interview with Lyft president and co-founder John Zimmer. That'll be on Squawk Box. Greg, I'll come to you on this one. What's your take? I mean,
Sure.
Initially jumped, which did come after a negative session, but giving up some of that initial jump now and down a little bit in after hours.
Well, they're doing exactly what we want them to do, right? They took the initial quarters, the last couple of quarters, to wring costs from the business, helping the operating leverage. They forecast that they can reach break even on EBITDA with about 80 to 85% of the volumes that they saw in 2019. March was a significant increase in volumes, a banner increase in volumes, and so I think that steady is the course. And if they can achieve that EBITDA break even in third quarter, this is as pure a play on the recovery as we're going to see.
13.5 million users there. Lyft shares are unchanged at the moment. Activision Blizzard is higher by 3% after hours. Let's get to Josh Lipton with those numbers. Josh.
Sarah, Activision reporting Q1 EPS here of 84 cents. That's versus expectations of 70 cents. 2.07 billion in adjusted revenues. That's versus expectations of 1.8 billion. For Q2 outlook, they're looking for 70 cents. Now, that is a nickel below where the street was at, but on 1.85 billion. Street was at 1.82 billion. They also do raise their outlook for the year after that strong Q1 performance. Now looking for 370 on 8.6 billion. CEO Bobby Kotick here in a statement saying the employees continue to demonstrate what he calls exceptional performance under challenging circumstances. He says that relentless drive across our franchises produced strong first quarter results that were well ahead, he says, of expectations. Our continued overperformance, Bobby Kotick saying, enabling us to raise our outlook for the full year. This conference call kicks off at 4:30 Eastern. Back to you all.
Josh Lipton. Josh, thank you. Paul Hickey, what do you do with a stock like this? Better results. These stocks, though, video games are well off their highs after they saw tremendous growth during COVID-19 and people were inside.
Yeah, so it's a tough comps going forward, and Activision is a name we actually owned heading into this report, but we were actually stopped out of it today on the decline. So we've unfortunately had it wrong, and as you said, it's higher after hours. So, unfortunately missing out on that, but just go or sticking to the discipline, and when you have a stop in place with any position, you have to respect those. So I think it's a great industry. We've liked it, but we were forced out of it. We're willing to say we're wrong when the market tells us we're wrong.
Let's get to Caesar's numbers. Contessa Brewer's got them for us. Hey, Contessa.
Hi there, Wilfred. Caesars reporting $1.9 billion in revenue. That number includes income from discontinued properties that still have to be sold, but still are earning money for the company. A loss of $2.06 a share adjusted, uncertain whether that's comparable to analyst estimates. But look, here's the key profitability metric that everyone in gaming is watching. EBITDA, earnings before interest, taxes, and all that. Coming in at $548 million adjusted, way above consensus of $428 million. And I want to focus on Las Vegas EBITDA numbers, $162 million versus estimates of $117 million. Stupendous margins in Las Vegas, more than 32%, trouncing the profit margins of the nearest competitor on the Strip. Although, of course, cost efficiency in these casinos has been a huge headline in the industry. And then those regional casinos, really strong performance, $418 million versus the $306 million estimate. We're hoping to get more insight about this acceleration in recovery from CEO Tom Reeg on the call. As you can see, the stock is now down about a little more than 2% in extended trading. This call starts in about an hour, guys.
Two words, operating efficiencies, really helping out the margin picture there. Contessa, thank you. Zillow earnings also out. Let's get to Diana Olick. Diana.
Yes, nice beat for Zillow. EPS came in at 44 cents a share versus estimates of 25 cents a share. That's likely why the stock is now up about 3% in after-hours trading. Revenue at $1.22 billion versus estimates of $1.102 billion. Now, part of this may have been because of some gains in their home division. That is the iBuyers, where they buy your home for you and then sell it. It accelerated much faster than they expected, they said, and that may have pulled forward some of those gains. And it may also be why Q2 guidance is a bit lower than expected. It came in at 1.23 to 1.28 billion versus estimates of 1.296 billion. That also may be, however, because mortgage rates are rising and home sales are slowing. Zillow did say that they plan to hire about 2,000 workers in 2021, up 40% from a year ago. Part of that may again be that iBuyer program where they're getting more agents in to buy and sell homes. The largest revenue source, IMT, that's internet and technology, was up 38% from a year ago. And also traffic to mobile apps and websites in Q1 up 19% year over year. So again, a nice beat for Zillow. A lot of that on that iBuyer program. Back to you guys.
Thanks so much for that one, Diana. Let's round things off. Greg, what's your take? I mean, a lot of earnings crossing tonight, but also over the last week. Are you concerned when you see big cap tech and others pull back off the back of such good earnings?
I'm not, because we to some extent we know why that's happening. I and others have been keeping one eye focused on the inflation numbers, and again, that is more harmful to tech and growth. But I'm not worried over the long term, because what I think this earnings season has demonstrated is consensus remains way too conservative. There is a powerful beat and raise. There is a powerful upgrade and upward revision cycle that will play out in the second half once we have a better handle on what those inflation numbers are going to be and how the Fed's going to react. And so short term will remain very volatile until we have some specificity on that. But again, I'm looking at those back half numbers, which are 60 and 50% in the cases of some sectors. They're pre-COVID levels. And I'm just looking at the opportunity for particular stories to deliver growth well above what consensus is expecting right now.
Paul Hickey, Greg Branch, thanks for joining us. Much appreciated.
Thank you.
Up next, Lyft shares volatile after reporting a smaller than expected loss. We'll ask an analyst what he wants to hear on the company's call, which